Just give me 1 second here. Let's mute YouTube. All right, what's going on? I don't know why. Every time I move to a new location, something goes wrong. Technical difficulties here. So, there we go. Wow, hopefully the internet's fast enough. That actually took quite a while to kick in there. So it looks like we are good to go here. So welcome everybody. This is episode 40 of the Volatility Barometer. Like I said, I always have technical difficulties. I'm a pretty good traveler, but every time I set up in a new location, I'm always frantic and something's going wrong. So definitely shout at me in the comment section if you can't hear me or if something's glaringly obviously wrong here, but everything looks okay. It might be actually a little bit slow. But thank you very much for joining me here today. Thanks for the support. I do appreciate you hanging out. And like I said, I'm in Dubai, and I'm going to talk a little bit later on about why I'm here. I think it might actually be helpful for maybe a few of you to hear that story. But the big question is, and there's a poll in the comment section, I put it out there, is this market crash actually worse than the 2008 financial crisis? And it's actually interesting when you do posts like that. It's not clickbait, by the way. I'm going to show you a lot of statistics that might actually surprise a few of you. But yeah, I'm obviously aware that right now the S&P 500 drawdown is about 23%. Financial crisis was 56%. So I know some of you are probably thinking, well, why am I even tuning into a live stream listening to somebody who doesn't know that 56 is a bigger number than 23? But bear with me. I'm going to actually prove a few things with some statistics, and maybe at the end of it, you might actually agree with me. So go ahead and vote in that poll on the in the comment section just at the top. Last time I glanced at it, it was 50-50. I did another one on Twitter. Let me just check that one really, really quickly here. Yeah, I had basically it's kind of 50-50. So 47% of people said 2008 was much worse, 38% saying that 2022 is worse than 2008, and then 14% saying they're about equal. So this will be a little bit interesting. Let me give you about a minute of housekeeping here, and then we've got a little bit to cover here, so we will get started as quick as possible. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. Okay, so thank you everybody for joining us here today. The best way to support my work, everything's free. Don't super chat, don't send any money, but definitely give the video a like for me for that YouTube algorithm. Looks like there's about 50 or 60 people here, and there's only 10 likes. So get those up for me if you would be so kind. And let's get into some data. So here's the rundown today. I'm actually going to show you that there is a strong case to be made that this market crash in 2022 is actually worse than the financial crisis in 2008. And I think that resonates with a lot of people. I'm definitely sensing a lot of frustration from investors out there really not understanding, why everything feels so terrible. We hear the S&P 500 down 23%. Of course, there's been market crashes that were a little bit worse than that. There's been a couple of them that were a lot worse than that. But there's just this vibe of pretty much everybody's getting killed from all angles. And I'm going to actually get into that, kind of show you why that might be the case if you're feeling the same thing. And then the second point there, not positive we'll get into that. I will keep an eye on the time. But I will explain why I'm here in Dubai. It's not actually for a vacation. I'm sure it'll be fun, but not actually here for a vacation. And then, of course, the open Q&A. So you can ask your questions now if you've got something on your mind. It helps me to just pick them out of the chat section if you put a Q or a question or put a bunch of emojis or something so I can pick it out there. And yeah, you can ask your questions. I do like to be that person who will sit down and answer questions. I know that's tough. You probably see people on Twitter. You want to ask them stuff, but they probably won't answer the DMs. I will answer your questions for you. So we will get into that later. Don't worry. So let's get right into it. Let me just see if I remember how to do this. Different location, screen share, spreadsheet. All right, everything's good to go. Sometimes I'll be just rambling on and people are just staring at my face. I didn't do the screen share. Okay, so what we've got here, let's get right into this. So I've compiled some data for some of the most, the asset classes that most people hold in their portfolios. I've got the S&P 500. The Qs is the NASDAQ index. We've got 20-plus year U.S. Treasuries. We've got 7 to 10-year U.S. Treasuries, gold, real estate, utilities, energy, emerging markets, U.S. dollar, commodities, and finally, long volatility. Now, I'm using VXZ really quickly here. I'll explain why I'm doing that. Let's see if we can load up VIX Central without my ad blocker. I am in Dubai, and I have to use some type of ad blockers and stuff. Okay, good enough. But the common volatility ETPs that you're probably used to seeing, the VXX, UVXY, SVIX, SVXY, all of those ones, the new UVIX, they're all using the front 2-month VIX futures. I like to use the M4 to M7 products. Those are the VXZ and the VIXM. And the reason for that is because over here on the far right of the VIX futures curve, it does tend to be a little flatter. They do move a little bit slower, which is a good thing because when you're trading long volatility especially, anytime that there's some significant vol crush, if the market bounces really quickly on you, which eventually will happen in any market crash, you can really get hammered if you're using those front month products. So typically, I'll use the M4 to M7, and for today's example, we are using those here. So the VXZ is our long volatility component. And then we've got the top 6 market crashes since the financial crisis and including the financial crisis being the number 1 largest. So if we analyze what was going on back then in 2008, I would say this is fairly representative of a typical market crash. Now, it's not typical because it was down 55%. That is insane, only outdone by the Great Depression, but typical in the way these assets are moving around. So you can see what's happening. The S&P down a lot, of course, NASDAQ down a lot. And I should mention, these are not necessarily the maximum drawdowns of all of these assets. These are just the drawdowns during the date for the S&P 500 drawdown. So the S&P 500 was at an all-time high on October 9th, 2007, and then it bottomed on March 9th, 2009. So all of these are representing the return of these assets during the peak to trough of the S&P 500. It's very close, but it might not align exactly with the data. But we've got the S&P 500 and the NASDAQ down. That is to be expected. Treasuries, 20-year Treasuries and 7 to 10, both did extremely well in the financial crisis. This is that old inverse correlation between the stocks and the bond market. Gold did very well as well. It was a little bit volatile at certain spots, but very good performance. Real estate got murdered, of course. We know that the 2008 crisis was largely affecting real estate, so that's not surprising. Utilities, energy, emerging markets get killed, of course. I'll talk a little bit later about utilities and why they do a little bit better. But U.S. dollar did well, and that's typically always the case in a recession. It's funny, people talk about, the collapse of the empire and the fiat currency, and the U.S. dollar is toilet paper or whatever. It does actually quite well during recessions. And then we've got commodities. Typically, they go down during recessions pretty hard. And then, not surprising, long volatility is up. So like I said, I would say that this is pretty representative of the correlations between the broad asset classes. Now, what I want to highlight next is the average of the previous 5, not including the current drawdown. This is 2008 financial crisis up to the pandemic, which was actually number 2 here, but not including number 3, this current crash. So this is the previous 5 before this latest one. And again, we can see the same pattern developing. We've got stocks averaging, obviously getting crushed. We are measuring market crashes, so those are going to be down for sure. We've got treasuries doing well. We've got gold doing well. Real estate doesn't do very well. Of course, this number is elevated a little bit because of that disastrous 2008. But still, it should be significantly down. And then these ones down as well. Like I said, utilities doesn't crash as hard as the stock market. So utilities are actually a go-to safety position for me. You'll expect to lose money in a crash, but probably not as much as the stock market. And then again, like I said, US dollar is almost always up. In fact, I think it was always up in all 6 of them. Commodities get crushed, and long volatility does well. Again, very, very standard stuff, and pretty much the entire financial industry, financial advisors, RIAs, all those pie charts that the banks will put you in, this is what it's all based on, these intercorrelations between assets. Now, I don't know what your portfolio looks like, but hard to put a number on this exactly, but I would say, 90-95% of the investment world out there probably has something that resembles a 60-40 portfolio. Now, it might look like a complicated pie chart with several different asset classes, but when you really break it down correlation-wise, the vast majority of investors in the world out there are basically tracking a 60-40, plus or minus a few percent, but not an overly complex portfolio. So this is what those investors are sort of counting on happening during a financial crisis. Obviously, we're going to expect stocks to get destroyed, but we are expecting some offsetting results to kind of build that up. And if you're a more sophisticated investor and you do use the VIX futures, VIX options, maybe the volatility ETPs, buy a 2 or 3% allocation in the UVXY, for example, you might actually get a decent run through one of these major crashes. So here is the part that I wanted to illustrate and why there is actually a case to be made that this crash right here, current one, is actually worse than anything else we've seen, arguably since the Great Depression. Now, again, bold claim, but I'm actually going to back that up with some numbers here, so bear with me. So this is actually what we're looking at right now. This is as of market close yesterday. Let's just see what's going on today right now. That doesn't look right. Up 91. Did that just happen after I went live? All right. Well, there you go. Something's going on. We'll maybe dive into that a little later, but this is as of market close yesterday. So we've got the S&P 500 down 23. NASDAQ is, obviously it's getting crushed, but down 32 year to date. That's pretty awful. The first of 2 really big gut kicks for investors this year is the treasury market, of course. You've got the 20-year and the 7 to 10 years. They're getting absolutely destroyed. And this isn't the maximum drawdown. Actually, if you look at the TLT, the S&P 500 drawdown started here on January 3rd. But the TLT has been going down even further than that. So it's down almost 30%. This is, like I said, the first of 2 gut kicks why investors are doing so bad this year, because there's no inverse correlation for their portfolio. Remember, in the financial crisis, treasuries did very well. Gold did very well, offsetting all of those, not all, but half of that decline. Whereas here, you can see there's nowhere to hide for the standard 60-40 investor. People who add gold didn't get a very big pop. You can see 24% in the financial crisis, only 2.5% now. Real estate down. Utilities, again, like I said, pretty decent safety position. Not expecting to ever make any money in a crisis, but utilities should lessen some of the damage a little bit. This is a massive shock. Energy up 37%. We've seen that. Emerging markets always go down. They're not a good diversifier, in my opinion. US dollar always goes up. Commodities, obviously, we've also seen that. The second gut kick, remember the first one is the treasury market. The second gut kick, look at that long volatility performance. This is something that obviously for sophisticated investors who hedge their portfolio, like I said, with futures or options or vol ETPs, or tail risk funds that are out there. You've got a lot of the long volatility people on Twitter who, I'm sure you know the regular names. They manage tail risk funds. I think you'd be quite surprised how terrible the performance is this year. There's a lot of them where you'd think, wow, the markets are crashing. Those tail risk funds must be doing incredibly well. This year, actually not very well at all. In fact, some of them I've seen negative. Imagine that, markets crashing and tail risk funds flat or negative. It's, depends on the timing of things. But yeah, it's obviously been very rough. So this is why I said it's possible that this is worse than the financial crisis. So where's that little line? I can see it there. So what happens when an investor tries to diversify their portfolio? This is a 50-30-20, 50% stocks, 30% bonds, 20% gold. Now, instead of 50% stocks, you can see I'm using 25-25, half SPY, half NASDAQ. For the treasuries, I'm using half long-term, half short-term, and then I'm using gold. This is a very standard portfolio that, like I said, probably 95% of the investment world is mirroring plus or minus a few percent. So what would that have been at in the financial crisis? That one was down 15%. So pretty rough, but actually quite manageable when you think about it. Down 15%, it's substantially better than the 55. And that is because if you diversified, there were actually some pretty good places to get a decent return and make up some of that loss. Well, what happens if we look over during the current crash? This is the number that will prove my point of why this year feels so terrible for investors. Because this 50-30-20, exactly the same way, is down 18.36%, which is worse than the financial crisis. So, like I said, it's a pretty strong case that actually, from a real world trading perspective, if you have no safety positions to go to, then you don't actually need the stock market to decline 50 or 60% like it did before in order to really feel that pain. 23% is plenty for investors to feel realistically might be in their largest drawdown, including the financial crisis. You might have actually done better back in 2008 than now. But it gets worse, because what happens if an investor is a little more sophisticated? Now I'm transferring, instead of 20% gold, we're going to drop it to 15, and we're going to add a 5% exposure to the M4 to M7 VIX futures, which is, a reasonable tail risk allocation, especially since it's not the front 2 months, it's not leveraged. This is what I would consider still within the realm of responsible. Well, what happened to this investor? Well, now they only lost 9%. That's pretty solid. You might think, well, the financial crisis was a total disaster, but it actually wasn't. If you were a sophisticated investor, or not even overly sophisticated, just buy and hold, if you structured your portfolio even halfway decent, you could have actually had a single-digit drawdown in the financial crisis. Now, one thing I will say, before people in the comments get some ideas about, hey, this person just revealed the perfect portfolio allocation. Wow, an 8.5% drawdown during the financial crisis. Why don't I just do that? Well, it might be interesting for you to know that actually you probably don't want to do that. I've got the chart here. The long-term performance of that portfolio is actually in the, below 8%. So don't go rushing out there and saying, wow, this is just a genius portfolio allocation. It's really not. It's the same issues we have with buy and hold. It's the reason my business exists. It's because we want to be much more sophisticated. I'm trying to make 20% a year. I'm not trying to make 5%. And, this is a forward prediction. It's not based on anything other than my own analysis, but I would be actually quite surprised if this even continued. I would say that going forward, I would expect this to be substantially worse. Stocks and bonds certainly are not going to do as well in the next 20 years as they did the previous 20 years. And then we've got high inflation. So probably this is going to be not much better than inflation. Don't get too excited. But a 9% drawdown, that's not that bad at all. What happens if the person did the exact same thing right now in 2022? Well, 17.35% down. Not only did bonds not provide any protection, gold didn't do anything for them, and long volatility hardly made a dent. So now you've got a situation where a balanced portfolio in the financial crisis had half the drawdown of the drawdown it's showing right now in 2022. That is pretty significant. I think that this is something that, like I said, there's probably a lot of people out there that maybe don't dive into the numbers as carefully as I do. They don't track spreadsheets like I do. Probably wondering what is going on. Like, why does it feel like everything I do is wrong? Every time I buy something, it goes down, and then I think I'm being smart, and I'm going to move into safety, and then that goes down, and then you think, well, now I've got a window to buy stocks, and you get in there, and then that goes down. I'm experiencing the exact same thing, just incredibly frustrating whipsaw pretty much this entire year. This is why. It's because it's broken. The market is broken. It's not like it was before. All of the correlations have broken down completely. And everything that we expected to happen in all the previous 6 or 7 market crashes that was actually surprisingly consistent across all of them. You can see here, if we compare to the average of the previous 5, let me just close a few of these just so we can see what we're looking at. But this pattern that we see of these intercorrelations between the assets, it's actually pretty consistent. You can expect stocks to go down, treasuries to go up, gold to do pretty well, all of these to go down, but some of them not as much, like utilities. You can expect the US dollar to perform well. Commodities should not do well at all in a recession, and long volatility should crush it if you actually have some sophistication. This is what should have happened, and this is what did happen. This is the current crash. That's insane. There's absolutely nowhere to hide. And to make the point even more, this last column, current drawdown, which is now in 2020, versus the average of the previous 5, and this is the differential between them. So you can see the S&P 500 is actually doing better now in 2022 than it did on average in the previous 5 market crashes. It's doing better. The 23% drawdown isn't the average yet. It's actually better. But look at everything else. Look at treasuries, 40% differential. That is absolutely devastating for investor portfolios. Gold, not doing as well as it usually does. And then you've got things like energy and commodities just absolutely crushing it. Well, sure, you might have a small allocation to those assets, but typically it's going to be a 5 or a 10% just token diversification aspect. It's not really going to be a major part of a person's portfolio. The bulk of their portfolio is this, and we're looking at a massive historical differential there. And then, of course, the final one, long volatility, just unbelievably muted volatility response. Anybody who's been a volatility trader in the last 6 months, we can see the numbers. It's by far the lowest volatility reaction of any market crash. Narrowing down the why, that's a bigger question. This is something that I think about a lot, of course. A good portion of my investing is in the volatility markets. I'm not even sure about the why, but we know the what. It's been an unbelievably muted volatility response. So that's what people are facing. A balanced portfolio in 2022 is probably down twice as much as the same portfolio would have been in the financial crisis. And if you want to actually just go through the numbers really quickly, you can, let me unhide some of these again. Where did I do that? Let's start there. Some of these are just data. But if we look at some of these, let's take all of these to 16, just so we can reveal it all. You can see 7, so the financial crisis down 9, the one that includes a 5% long volatility. This one down 8, obviously 17, that's absolutely devastating. This is the current one. 7% for the Q4 2018 crash, where the stock market crashed 20%, but a balanced portfolio would have been down 7. This is the European debt crisis, 2011. Look at that, 2. Up, actually. That's because the volatility reacted what we would actually expect to happen. It was a surprising, pretty scary crash, and volatility balanced that out nicely. But even without volatility, you would have been flat because treasuries actually absolutely killed it during that period. You got the China, call it whatever you want, China hard landing scare, down 2. So the average is actually 6 of all of them. But the average of the previous 5, not including now, it's only 4.6%. Then we've got this year, down 17, 18. And And that's not using leverage. That's S&P 500, a balance of short and long-term treasuries, gold, and a very responsible allocation in M4 to M7 long volatility. You start adding in things like leverage or individual stocks. Some of those are down 60, 70% this year. I've been screaming quite loudly about what a disaster the ARK fund is, but if you were a person who actually believed in that, well, there you go. The ARK is down about 70. If you were a person who does treasuries, the TLT is a common allocation. That's down a lot more. Silver down more than gold. You can start to even take that 18%, and you can see it can get to 25, 30, even 40 pretty quickly if you're choosing slightly more aggressive positions. It's bad. Basically, I'm not even sure what the point of all of this is other than to give people an explanation for why they are so tremendously frustrated with 2022. It's been a rough one. And if you are hurting, if your portfolio is down a lot, I'm easily my largest drawdown in my 17-year investing career. I'm not going to say like it's okay, don't worry about it, but it is one of those situations where this is hard to say because a lot of people suffer from recency bias. So they're oftentimes when you make statements like I'm about to make, people are like, oh my God, all I care about is what's happening in those 6 months. But if you had a portfolio that actually did well this year in 2022, I'm not sure that would be a good thing, to be honest, because if you were optimized for 2022, that probably means you were very poorly optimized for all the previous 7 crashes. I am a person who has a 30-year time horizon with my investing. Again, careful with my words. I'm not going to say I don't care about one single drawdown. I do. Obviously, I do. But I would rather deal with the previous 7 really well and then be surprised by this one and not be optimized for the outlier, which is 2022, rather than the opposite. If there's people out there that are bragging about how awesome they're doing in 2022, the very first question I would ask them is, I need to see your performance for the previous 10 years because I don't think it's very good. Being optimized for 2022, that's not a good thing. So I'm not giving everybody an excuse or an out. Obviously, we're all upset with performance, but be careful to beat yourself up too much. It is reasonably justified to be having a really bad year this year. And no matter where you are, if you're a bond investor, you're probably having a really rough time. If you're a stock investor, largely stocks, individual names, I don't even know what your drawdown would be, but it probably not much better than 30 or 40. If you're a volatility trader, it's been rough. If you're a tail fund manager out there, you're on Twitter, you've been talking for 10 years about how you're just waiting for the market to crash and then you're going to show everybody how well you perform. And then all of a sudden it happens and everybody's like, well, what's going on? Like, is this thing on? Why isn't it going up? Yeah, it's been rough. Sorry, folks. I wish I had better news, but that's why I can confidently say that probably 2022 is the worst investing year, certainly in our lifetimes. I don't want to go back to the Great Depression. That probably would have been worse. But yeah, the financial crisis would have been quite a breeze to manage compared to this one. So don't beat yourself up too much if you are hurting. Let's just make good decisions, do the right thing, don't get frustrated, be patient, stick to the process. The longer you make good decisions, maximize those good decisions and minimize the bad decisions, law of large numbers over a long period of time, multiple years, decade or longer for most of us, it's going to work out. It really will balance out. But what you don't want to do is to try to start forcing things because this market is crazy. There's nowhere to hide. There's no asset class performance or correlations that are holding up. You don't want to make any mistakes right now. So, cash is always an option for people. If you're done and you just don't want it anymore, cash works. But again, don't try to optimize for 2022. This is not a market this is an outlier. Don't ever optimize your trading for an outlier. I guess that would be the lesson there. Check the time here. See if I have time to talk about Dubai for a couple minutes. Just because I think, this might be helpful. I talk about my own life, and I am a chef who eats his own cooking. I would never say anything that I don't personally have experience with. So why am I in Dubai? Well, I essentially call this going into my cave. I'm not here for vacation, like I said, but there are times in my life, and I'm sure some of you watching, there are times in your life where there's certain things that you know you have to do, or there's things that you think you should do that might forward your career or might make you a better person or advance you into a place where you might have a better lifestyle. But when we're in our familiar surroundings, we're surrounded by our family, children if you have them, friends, hobbies, you know where all the grocery stores and movie theaters and everything is, and you're comfortable. I'm not saying that people are lazy or procrastinators. I'm actually a really hard worker, but sometimes you just feel like you're stuck. You feel like you know you should be doing something, but there's just a lot of temptation to waste time when we're in our familiar surroundings, when we're around people. Like, I'd rather hang out with my wife than do my work. It's just more fun, obviously. But sometimes, what I call it, sometimes you just have to go into your cave and get it done. So my first experience with this, I used to be a professional golfer, for anybody who doesn't know. So in 2000, when I was an amateur, I was one of the top-ranked players in Canada, the top-ranked player in Canada for a while. I went to the Canadian Tour Q School, turned professional. I won the Canadian Tour Q School. And, I was off to the races. I was seemingly off to a very promising career. I got out there. I tried the Canadian Tour for the first year, and it was very familiar to me. All the players, I knew them all. We were all friends. I had played all the golf courses throughout Canada. I'd been to all those cities. It was all very familiar to me. And again, I'm a hard worker, but there is just that familiarity that for some reason I just felt stuck. I felt like I wasn't progressing. So back then I made a very odd decision against what all my other friends were doing. I actually packed up and I left, and I went to Scottsdale, Arizona. I moved down to the US. I played different golf tours in the US, trying my luck on, back then it was the Nationwide Tour, and I was playing the Gateway Tour and some of the other mini tour events in Florida and California. But I set up shop in Scottsdale, and I moved down there. I didn't know anybody, never been there before, rented a little studio apartment, didn't have a bed, didn't have a TV, had nothing. So of course, when I'm in my apartment, I just wake up in the morning and I just immediately go to the golf course. And then when I'm at the course, well, I'm already here. What am I going to do? Go home and stare at a wall? So you end up spending most of the day practicing your golf. And if I do happen to go home, nothing to do, go out for a workout, go out for a long run. That's actually when I started running. And now I've run marathons. But my fitness improved, my golf improved, I was making more money. And it was because I was out of my comfort zone. And sometimes you do actually have to do that. So second time I did this is I was a full-time trader. I retired from golf in 2005, traded full-time until 2011. And then in 2012, I had the idea, basically in 2011, that I wanted to start sharing my work and actually educating people and allowing people to follow my portfolio because I was doing so well. And but it was just an overwhelming amount of work. I was busy full-time. I had friends, I had hobbies, I had Vanessa there, and it's just really, really difficult. So I knew that I had to try to just eke out an extra 2 or 3 hours a day. I had to figure out how to do that. And so again, I went into my cave. I moved from Taiwan, away from Vanessa. I left all my friends and hobbies, and I went back to Calgary. I was born in Calgary, but hadn't been there in 20 years, hadn't lived there. Lost touch with all my friends, moved to a place downtown, 30 miles away from where I grew up, didn't have a car, again, didn't have a bed, didn't have a TV. And I just grinded. And for 5 months, I was just writing every day. I was making videos. I built a website. I did all the things I needed to do, and I launched that business that I knew that I wanted to do. And I don't think I would have done that. Again, I'm not a procrastinator, but I needed to be out of my comfort zone to get it done. So I went into my cave and I did it again. So now I'm faced right now with a situation where from 2012 to 2021, I actually started my career as a derivatives trader. So options trading has always been a major portion of my portfolio. And last year, I suppose, victim of my own success. I very much appreciate all the support from you guys, but I was too busy, and I had to choose between one of the two. And I chose to continue with the tactical trend following strategies, put the options on hold, and I would circle back later on. And I just find myself incredibly busy, and I just I wanted to do it. I sit down and do it. I tried to get it all done, but it's just an overwhelming amount of work to do that while I'm already busy 70, 80 hours a week doing the other thing. So that's it. I just had to go into my cave. I got to find those extra 2 hours a day. And the only way to do that is to exit my comfort zone. So I left my wife, or I shouldn't say it that way. I didn't leave my wife, but I left Taiwan. I came to Dubai. I chose Dubai because I'd been here before, but I've never been here in the summer. I thought it was going to be blistering hot. I wouldn't even go outside. It was kind of one of those things. There's a TV there, but I'm not going to turn it on. Turns out, actually, the weather's pretty nice here. Dubai in the summer is completely fine. But anyway, that's what I'm doing here. So if you are a person out there who, like I said, you've got that thing that you know you need to do, or that business that you just need 2 or 3 extra hours in the day, don't hold yourself back to stay in your comfort zone. Sometimes it would be worth it. I mean, even if you had kids or something, sometimes you got to leave the wife and kids behind, and you got to go somewhere for 4 months and just do what you need to do to fix your life and to get it forward. So like I said, I would never say anything I don't have experience with. It is lonely sometimes, but sometimes you got to go in your cave and just grind it out and get the work done. So I'm going to be in Dubai until I relaunch that options course, and I'm just going to work as much as I possibly can doing that. So that's my story. Yeah. All right. So let's do that. Took about 6 minutes. So sorry about that. But sometimes people like when I open up my own personal life a little bit and share some of what I do. My life is a little bit different. I would say 2022 is an outlier for investing, and I am an outlier as far as lifestyle goes. Digital nomad, traveling around, living in different places. It's not for everybody, but yeah, I'll share my life if you guys are interested. Anybody who tunes in, as long as you keep tuning in, I'll keep doing it. So, okay, I'm getting an error message. That's not. That's fine. Okay. Would like to see them more often. I'm always surprised how hedge funds don't pay you hundreds of millions to get your strategies, since they perform better than 99% of them. So there's a couple of things in here. Thank you for the support. The second point you made, you'd like to see more of them. I will commit to more of them. I'm a super, super busy person. Like I said, I'm minimum 70, 80 hours a week, and that's on a good week. But I think I will try to commit to putting something together every week, and can't promise it, but I'm here for 12 weeks for sure, probably for 16 or 20 to be honest, because I've got a lot of work to do. But I'm going to commit to live stream a week. As far as hedge funds paying me hundreds of millions, they don't pay me hundreds of millions, but I do have another business called Prosperitas Financial. I've had that for over 10 years now. It's my consulting firm, so I do consult to other funds and family offices and RIAs and whatnot, and people can either purchase or license what I do, and if they do that, I help them out directly. But that's all done on a consulting basis. They don't pay me hundreds of millions, but they do pay me. So I prefer to do things by myself. Like I said, I'm an outlier as far as lifestyle goes. I don't play well with others. I don't like when people tell me what to do. I'm just that type of person. I'd rather just do it myself. So, but I do work closely with a few funds out there. Some of them you've probably heard of, but I keep Prosperitas totally separate from VTS. It's obviously you're treading on dangerous waters there as far as solicitation of clients and whatnot. So I barely even mention it. Okay, Denise, what do you think of Bitcoin? Oh, don't make me rant. Let me do this really quick, because actually next week's live stream, I'm planning to unpack this idea a little bit further. But my basic back of the napkin, I think Bitcoin and all of the crypto space is, brace yourself if you're a crypto person. Actually, maybe I should say before that, I do actually own 2 Bitcoins. So I'm not trashing it from the sense that, I'm not participating in the market. I actually do think it has a pretty decent chance to go up in price. But as far as what it is in general, I think Bitcoin is completely useless. I think crypto is totally stupid. It's not useful at all in the world. And the example that I always give is, let's say you woke up tomorrow and crypto was at zero. Literally, for some reason, it just all went to zero. Bitcoin was zero, Ethereum was zero. All of the projects out there just got halted. All the VC money just dried up. Nothing would change. I mean, some people's net worth would change, but the actual functioning in society, absolutely nothing would change. We would look at that and we'd go, huh, that's weird. Just go on about our day. Nothing would happen. Stocks, real estate, bonds, precious metals, all of these markets are absolutely foundational to the global financial system. Crypto, I mean, it could blink out of existence tomorrow and nobody would really care other than the people that were speculating and their value goes down, but the world wouldn't notice. So, no, I mean, my opinion is it's not technically a Ponzi scheme, but it's, it walks like one and quacks like one for sure. So it is the ultimate greater fool investment. And when we say greater fool investment, I'm not calling people fools. It's not a derogatory thing. It's an economic term. The greater fool theory is basically that something doesn't have an inherent value. It is only valuable if you can get somebody else to buy it at a higher price than you bought it. You might say, well, that's true of all assets, but not really. I mean, there are cash flows and foundational reasons why stocks are valued and their companies and real things behind them. But Bitcoin's a greater fool investment. So I bought 2 Bitcoins quite recently. So I'm in just under 25,000. So I bought the first one at 29.5 or something. Bought the second one very recently, I think 2 days ago, maybe 2 days ago. So my average is about 24.8 or something like that. And the only thing is, it's just a speculation play. It is a social media play. I do happen to believe that these new influencers, if you call them that, they do have a tremendous amount of influence. And they can dupe their followers into buying pretty much any garbage that they sell them. NFTs, crypto, buy this coin. So for me, buying Bitcoin's the only one I would ever buy because the whole thing is kind of a scam. But Bitcoin itself, I think the price might go up in the future simply because the just tremendous momentum of these social media giants out there that are promoting it. I think that's going to be enough to make it a decent speculation. But I wouldn't own any of the other stuff. I wouldn't, people talk about, the blockchain's so useful. I'm willing to be proven wrong. I mean, send me something that you think that the world really needs with the blockchain, but I don't see it. I think, like I said, it could blink tomorrow and I would just kind of go, all right, I'm going golfing. Wouldn't really even notice. So, Armin, I wonder if it's possible to run an auto trading system with your signals. Do you have a suggestion or do you offer such a service? Well, there are auto trading services out there that will take something that's like what I do, a newsletter, an email, signals of trades, and they'll actually, you're signing basically a quasi power of attorney with your broker where they are going to execute the trades on your behalf. And these exist, and there are signals and strategies that you can follow out there, and you can set up auto trading with your brokers. The problem is, technically that's illegal. I've certified and passed all of the qualifications to be a portfolio manager in Canada. I've done not only the basics of what you need, but an extensive, higher end portfolio management. But I don't live in Canada. I'm not registered in Canada. So technically, I'm not a registered financial advisor, which means I can't act as a custodian for anybody else's money. So if I set up auto trading, it is a gray area in this market. I mean, it's not like the SEC is going to come knocking on my door here in Dubai and stop me, but it is technically illegal. And all of these people that are participating in auto trading, if you are not a registered advisor, technically you're not supposed to be acting on behalf of someone else's money. So I don't do it strictly because I like to do everything as honestly and above board as I possibly can. But it's technically possible to set up auto trading, but I don't want anything to do with that. I just want to follow the letter of the law. Call me the goody two-shoes of the financial industry, but I'm really very, very careful not to violate any soliciting things. You'll never see me on Twitter, peddling things and, asking people to join here. It's so cheap. I'm having it discounted this month. I don't do any of that stuff. People know where to find me. My portfolio does extremely well long term. And if you need help, I'm here. But yeah, it is. I don't know if the SEC would ever crack down on it, but yeah, that is. You might want to question the ethics of somebody that would do that. There's two ways to look at it. Either A, they don't know the actual regulations in the financial industry, which would be alarming. I'm not sure if I would take signal advice from somebody who doesn't actually know the basic laws. Or B, they know and they're willing to break them. I don't know which one of those is worse, but they're both pretty bad. So all of these auto trading services out there, I would tell them to be careful. If something bad happens, don't be surprised if some lawsuits get thrown around, because you are not supposed to be acting as a custodian for people's money. Nothing wrong with telling people, hey, this is not a recommendation, but here's what I'm buying today. If you'd like to do that, go ahead and do it in your account. You take the trade yourself. Takes 1 to 2 minutes. It's fine. My service takes 2 minutes maximum to enter the trades, but you've got to do that yourself. Okay, will the 2022 crash murder real estate harder than equities because of the oncoming slow rate increases? And if so, how does that affect your strategy? So that would be a guess, but real estate crashing will probably be slower than the stock market. Not only slower in the crash, but also a delayed reaction as well. So it wouldn't surprise me at all if there's a major real estate correction coming within the next 2 years, something like that. But to tie a real estate crash into this sort of year-to-date stock market crash, I don't think that the timing is going to be quite lined up there. So I think the much bigger concern for investors is still the stock market and the safety positions that we choose. And the second part here, if so, how does that affect your strategy? Well, my strategy is affected only in that my safety positions are performing terribly this year. Like we showed, we've got a situation where all of the normal correlations, which really have held up very well through all the market crashes, and certainly in the last 35 years since 1980, those correlations have held up. We've got a situation where where's the safety? Like one of my strategies moves to safety, which is real estate, and VIXM, which is structurally identical to VXE. So that's the strategic tail risk. Well, I've been bouncing around between two assets that are not doing well. Obviously, real estate's getting killed, and long volatility, I've been getting sort of 1 to 2 day timing errors where you get the signal one day and then the market goes down, and then you get the signal the next day and it goes back up, and you get whipsawed. I've got another strategy that's using utilities and cash. So my NASDAQ strategy got killed in January, but it's actually done pretty well since then because we've been in XLU and cash. The third strategy I have is quite reliant on gold to provide a little bit of insulation. And then our fourth strategy is an option strategy that's doing very well. So I've got 3 tactical strategies that are relying on certain safety positions that historically should not be going down this much, but are in 2022. So how does it bode for my strategy? If this outlier of a market continues, I'm mitigating the damage of the stock market. Like I have a leveraged portfolio that's, its drawdown is actually less than a 60-40 unleveraged. So it's not like I haven't mitigated the damage. I have successfully done that. But it's going to continue to bleed down as long as the safety positions are also bleeding down. Otherwise, maybe things turn for the better. I mean, who knows? Like the market, what did we say? It was up today, I suppose. Yeah, who knows how it affects me? I would imagine I will always perform better than any buy and hold portfolio out there. But I'm not, you can't turn garbage into gold, basically, and we don't have much to work with. I'm not a person who puts large percentages of my capital into commodities, for example, or oil or anything like that. The US dollar, those don't perform well 95% of the other time, so I don't even mess with those. The ones that I hold, some of them are not doing very well either. So Okay. First live stream. Welcome. Thanks for coming. Hopefully you got a little bit of value and you'll tune in for next week. I'll always think of some type of topic to rant on. Sometimes I go a little bit too long. Like I talked about in my Dubai thing, it gets a little lonely being isolated. So when I get to talk to everybody, I've got so much to say. But yeah, I'll pick something interesting and come back next week. Okay, Chris Moon. Just found your channel and want to say I really appreciate your content. Thank you so much. Indeed, things have been brutal the last few months. Scalping seems to be the best play these days. Yep. I mean, if it's working for you, fine. But the problem there is, I'm not picking on you, by the way. Thank you for finding the channel and supporting. I do hear stuff like that spoken quite a bit, where you're in a difficult market and people are like, well, here's the answer. You're supposed to be, scalping or gamma scalping, or XYZ is working really well for me lately. The problem with that is it your whole net worth? Is it for the last 10 years? Oftentimes when people are online and they're saying stuff like, oh, I've been doing this and it's working really well, what they really mean is I've got a very small portion of my capital allocated to a certain sort of strategy that is happening to do quite well. But they don't actually mean like their entire net worth is growing successfully in 2022. I've also got an option strategy, my vol trend strategy, for example. I think it's up, can't even remember, 7. My VIX option strategy is up 11, I believe. It's more than that, maybe 13 now. Iron Condor's crushing it. Like my option strategies are killing it this year, but my net worth is down. I'm down sort of everything that I do personally, trend following mixed with options. It's down about 8 or 9% right now, year to date. So when I say I'm struggling, I mean my net worth is down 9% this year. That doesn't mean I don't have plenty of things that are working very well. So if you've found something that's working great, that's awesome. We all need some things that are working well. But I think the larger concern for investors should be, what is the bulk of what you're doing working? Is that working? And I think the answer for most people this year is going to be an affirmative no. So I hope you're an outlier and that you have found a way to make your whole portfolio positive or flat maybe. But like I said earlier, be careful optimizing for such an odd market. I don't think you really want to do well in 2022. It might not bode well for the future when this type of market doesn't circle back very often. Favorite hockey team? I haven't started. Once I left Canada, I left Canada about age 21. So, to age myself, that's 26 years ago. I'm 47. So I stopped watching hockey 26 years ago. I don't even really watch golf anymore. I might watch the US Open, but I'm going to probably just stream it for like 45 minutes or something on Sunday because I am here just for work. UFC, yes, I'm a huge UFC fan. I watch every UFC card. So, yeah. Hello from Scottsdale. Yeah, I lived in Scottsdale for 5 years. It's actually kind of one of the reasons why I chose Dubai when I'm doing this in my cave adventure here. I thought Dubai was going to be just scorching hot because everybody's told me that, oh, it's way hotter than Arizona. It's way hotter than Las Vegas. And I've lived there for 5 years. So I know, I used to golf in the summer, just in the daytime in Scottsdale. And it's hot, but it's fine. So I thought here would just be excruciating. It's actually not. It's beautiful here, especially at night. About 7 o'clock, the sun goes down, and it's great. So I misjudged that. But I miss Scottsdale. I have heard, though, that it's not maybe what it used to be, which is too bad. How far do you think this still has to go? I have no idea. I don't get into personal predictions like that. I mean, I can answer the question if you want me to. But it doesn't influence any of my trading. My trading is just quant-based analysis. The strategies are built. The signals are there. I follow the volatility metrics, and that's what it is. But if you wanted me to just take a guess, boy, I don't know. We're down 23% right now. I would, come back in a few months and see how close I am to my guess. I would imagine we're getting very close to a short-term bottom. I think there'll be a pretty strong relief rally at some point where we're going to see the market go up, 10, 15% in a matter of a week and a half or 2 weeks. And everybody's going to kind of think that everything's solved. And then the reality of these rate hikes are going to kick in again, and people are going to realize, oh, wow, the mortgage rates are skyrocketing. The debt is all this. You've got all these people who quit their jobs because of the PPP and stimmy checks, and the labor force participation rate was low. But now you've got a situation where last year everybody thought they were wealthy, so a lot of people were choosing to exit the workforce. Now you've got a situation where asset prices are down, crypto's down, all of these things are down. Real estate's going to start to go down. People are not going to feel as wealthy as they used to be. And then they're going to probably want to pour back into the job market. But at that point, it's going to be a recession and there's not going to be a whole lot of availability. It's going to be rough. I think in general, the number of miscalculations from the government to the Fed to the individual level to just how we've managed our society for the last 3 years, just the magnitude of how many miscalculations we have all collectively had, I think it's going to come to a head at some point, sort of mid-late summer, fall. I think it's going to be pretty ugly. That's my prediction. But again, I want to reiterate that I don't trade based on that. It's not like I'm going to try to get in there and time it all. I'm just going to follow my system, follow the volatility metrics, make small tweaks here and there. I am considering moving a few of my safety positions, more cash heavy. But other than that, I'm just going to follow what's worked for me for 17 years. That's just a prediction. I think we're going to see a relief rally, and then the bottom's going to fall right out. Could you elaborate on the option course? Not particularly, to be honest, because I've just gotten started. But I've been derivatives trading for 17 years, and we did have the VTS options service before. It was, VTS is trend following tactical, and then VTS options is discretionary options. And it was very popular. There was, 700 people on the list or something like that. And I just got too busy. I just got to the point where I was getting way too many emails, and I prioritized answering questions from community members more than, expanding and basically taking the money to continue to grow the business. I just made a decision to cut that community out and focus on the original community, and then I'd circle back later. So when I do the next one, it's probably going to be in the form of trade signals plus an options course. I think the course is going to be vital because I do get an awful lot of emails every day. I'm always a very open, generous person with my time, and as a result, I do get an enormous amount of questions coming into my email inbox. And so I think the foundational course itself will help clear up a lot of those questions. So yeah, I'm gonna put together something that I think people are gonna really, really appreciate. Essentially, what I want is to have a course out there that it's going to be lifetime membership. It's not going to be me trying to scalp extra money. Not to be, whatever here. I don't need the money. But you need to, put a foundation of something together and charge money for it and have an actual community around it. Otherwise, people don't take it seriously. But it'll be a lifetime membership, and I really want it to be sort of like the only place people need to go to forward their option trading career. I know there's, people bounce around all the time. Let's try that one. Oh, that one sounds great. That one's up. Let's go over there. This one sucks. Let's cancel that. I just want to build a community where people can feel like for the foreseeable future, I will be adding strategies. We'll do live streams. We'll do, workshops, and just I want to make it really, really good. That's why I made the sacrifice, and I sacrificed my own life, my own money, my own income. I hate talking about money, but I gave up hundreds of thousands a year in canceling the options course, just so a year later I could do it better. And so hopefully I do well. Hopefully I can maintain a certain standard that people are interested in. I do hold myself to a pretty high standard, so I think it'll be good. But details are coming. Give me a few months. Did your barometer signal this crash? That's an interesting question. So yes, the barometer signaled the crash quite quickly and quite easily, as it always would. But the interesting part was it didn't signal the full crash that it turned out to be, which was actually a problem for me. So what I mean by that is my volatility barometer, it doesn't go from 0 to 100. it's actually geared so that it's, the lowest is about 14, the highest is 91. But right above about 82, 83 is when it's like full red alert. Let's get full long vol, full cash, gold, all that stuff. That didn't signal hardly at all during this crash, which has been very interesting and also very frustrating. So I have been pushed to the mid-safety positions of real estate, utilities, and gold, and some cash quite regularly for the last 6 months. But it didn't fully get me out of everything and into full long vol, full gold, full cash, like I should have been in all the other previous 6 market crashes. So, kind of my specialty is risk management. I have a portfolio that it just does extremely well long term because I don't suffer those big drawdowns that most people suffer. But this one, there's just nowhere to hide. And the traditional safety assets just really unfortunately didn't provide a whole lot of safety. So I got caught out as well. Now, fortunately, I'm a very good option trader and I have a lot of strategies that offset some of those losses. So like I said, I'm down single digits this year overall, but my trend following strategies are down substantially more than they usually are, so yeah, kind of a yes or no there. Yes, it signaled the crash. No, it didn't signal it to the magnitude that I was hoping that it would have. Tomato. How do you keep yourself fit with busy lifestyle? You look super fit. Oh, thank you. I've actually had people all over the spectrum try. I guess it's because on camera and whatnot, you can't always. I don't care what I look like. I'm not like that at all. I don't position the camera angles and get the lighting flattering or all that stuff. I just turn on the camera and go. So I've had people say, "Oh, you look like you're 5'6", and you look like you're you could lose a few pounds." And I get other people who say, "Oh, you look like you." Thank you very much. Just to answer the question, in case anybody's wondering, I'm 6'1", about 182 pounds. I do run about 160 kilometers a month. So I do about 4 marathons a month, not consecutive. I run 12 times. I do thirds and halves marathons, but I run. I go to the gym. I track my calories. I have terrible genetics, really, really terrible genetics. My family history is not one of fit people. Let's just put it that way. So I have to work exceptionally hard to stay in anything close to good shape. I tell my friends oftentimes, I work out like an Olympian to get this. Like, this is the best it's ever going to be for me. I work out a lot. I track my calories. I have spreadsheets. I make sure I don't cross 2,400 a day. And if I had better genetics, I'd probably be one of those YouTube fitness people, but I was just born this way. It is what it is. Back, I used to be a competitive swimmer when I was really young, and I remember I was in swim club when I was 7 years old, and they used to do fat testing. They used to take those clamps and they used to test our fat percentage, body fat percentage, every month. And I was the second, I don't know if it's even politically correct to say, but the second fattest person in swim club. From age 7 to 14, and then I quit swimming. I went into hockey and golf and a bunch of other sports, but yeah, just blessed with bad genetics, unfortunately. So yeah, I work out like an Olympian, basically. 4 marathons a month. It's not easy, especially out in this 41-degree heat. But keep smiling. Agreed. Digi, currencies useless. Yeah. So some of those asset classes that are doing reasonably well are not things that that we can really allocate any significant portions of our capital to. It's unfortunate. So it is what it is. How far do you think we are from the bottom? Like I said just a couple seconds ago, I think we're almost there. But I think the real bottom, when the reality of how grim the financial situation is and how terrible the economy is and how awful we managed it, and the fact that it's one of those crazy things. You stimulate the economy with, trillions of dollars. And then the bubble deflates anyway. And then what are you left with, right? So in 2020, before the pandemic, the Fed balance sheet is 4.1 trillion, and it's going down. It was actually got down to about 3.7 trillion. Everything, it's not on track. They're never on track. They're 10 years behind the curve. But it was sort of trending in the direction where you could think, okay, enough craziness, it's kind of... And then you get COVID, and everything just inflates like crazy, but so do asset prices. And then what happens? The economy 2, 3, 5 years later realizes that it was all nothing, right? It was just stimulus. No goods or services were increased. No productivity was improved upon. Nothing happened. It was just massive stimulus of money printing. So what happens? Eventually, the bubble bursts, asset prices come down. Everybody who thought they was on paper net worth wealthy because their 401ks are up and their house value's up and their crypto's through the roof, that all goes back down to square one, back where we were in 2020 before the pandemic. But what doesn't go back down is the $9 or $10 trillion Fed balance sheet and the inflation at 8.5%. So what was it all for? It's just, I'm not a person who calls the Fed people and the government and the powers that be and the man, so to speak. I don't call them stupid. You could make a case that that is the most idiotic thing to do, right? But they're not stupid. They have a plan. They're getting rich. They are enriching themselves. They're not dumb people. These are Harvard and Wharton graduates. They know exactly what they're doing. To sit back and say, oh, the Fed are a bunch of morons. They don't even know the first thing about the economy. Boy, we are wrong when we say that. They know a lot about the economy, and they are absolutely engineering it to make sure that they get rich and we all get poor. So that's what we got. That's what we got. We're going to get asset values that deflate lower than the previous 2020 highs, and the only thing that's not going to deflate is the terrible bubble economy with debt and inflation. So I don't even know what the original question was. I'm just going off on a rant. I just get so upset with just the tremendous mismanagement of the economy, and it really bothers me. So that's why healthy portion of my investing is market neutral, option strategies, tail risk strategies that are designed to profit when this thing finally goes off the rails and it really starts to elevate. I know it's coming. So that's my take. The bottom is close, but within a year, we're going to see some horror, I suspect. Unfortunately, I'm still relatively new. I think this is back from the original question. You said you were scalping, and it's working out well. Yeah, I wasn't picking on you. I'm happy that you found something and it's good. There are things that can work in an environment like this. It's just the problem is that balancing act between how much of your capital do you put towards strategies that only work in real niche markets. That's the balancing act that traders have to do. Because there's always things that'll work. No matter what the market is doing, there's always something that's working. I have a portfolio of about 10 strategies, 4 trend following, 6 or 7 option strategies. I always have 2 or 3 that are working very well. It's just calibrating that allocation sizing is really one of the, it's an art, and it makes or breaks your trading long term. So how much are you going to allocate to your scalping? Don't go overboard. Remember, 2022 is an outlier. Don't optimize for this year. Make sure you optimized for the previous 15 years and forward 15 years. That's what you should do. Will I do teaching classes? Not really, but we'll do like workshops and strategy building. And I really want to open up my spreadsheets in the future and show people how I build my strategies and do some more interactive things as well. Once I get the actual thing done, it's about 75 videos, the course that I have laid out. Now I just got to start banging out those videos, which sucks because I can't even find a video editor to help me. But once I get the actual course done, I think then the fun begins. And I think we're going to be far more interactive in the future than I have been in the past. I'm never one to not admit mistakes. I think that admitting mistakes is how we forward ourselves, of course. And one of the things that I'm actually quite poor at is directing my focus on the things that matter the most and outsourcing everything that doesn't matter as much. I'm always the type of person that does everything myself. Back in school and university, when you get put together with 3 other people on a group project, I was always the type of person that just said, feel free to help me if you want, but if you want to just take a vacation, I'll do the whole thing myself. I'll take the project home. Give me 2 weeks. I'll present it. You guys can put your name on it. You can pretend it was yours. I don't care, but I'll just do the whole thing myself. And so when I'm managing my business at this point, it's just an overwhelming amount of work. And so I do have to learn that skill to focus 100% on my strengths and just outsource the rest. So I'm on that journey now. I'm trying to hire. I've never hired anyone. It's rough. Like I said, I don't work well with others, but I'm a perfectionist. But at the end of the day, I need help. So if anybody out there, by the way, if you're watching, if you are a really good video editor, what I want you to do is I want you to watch my most recent 4 videos. I want you to watch this one, strategic, defensive, short vol, and gold strategy, the tactical balanced. Watch those 4. Watch the editing style that I used. It's a very minimalist style. I like it to look professional. I'm 47 years old. I'm not a 22-year-old vlogger, on YouTube. I'm a professional, so keep it classy. But if you can duplicate that, there's a job waiting for you. And, I don't want to, you never want to, what I'm hoping is I can find somebody who just, without me telling them how much I'm going to actually pay them, they actually just want the opportunity to work with me. But there's money there. So if you are a good video editor and you can duplicate a professional looking style, definitely email me. They engineer their cohort getting rich, friends that put them in, keep them in the office. Yeah, absolutely. They are not dummies. These are the puppet masters of the world are seemingly completely stupid, but actually quite genius and quite brilliant. And that's the scary part is that, Ben Bernanke, not a dumb man, a very, very smart, savvy economist. Brilliant guy. Janet Yellen, not stupid, very, very intelligent. Not going to go that far with Joe Biden, but, you get the point. Most of them are, they pretend they're dumb, but they're getting extremely wealthy off of all of this. So, yeah. Okay. Oh, no, that's not it. JD, Valentina. I know I missed one. Here we go. Apologies for the silly question, but I cannot find the answer in the Q&As. When it comes to the percent allocation of your strategies, does that mean 25% of your total portfolio is allocated to the trade? Yes. For the VTS strategies that you see now, this is VTS options excluded. That 25% means, for example, today in the strategic strategy, we are exiting the IYR and we are buying the VIXM. So you take 25% of your net liquidation value of whatever you've allocated to VTS. I can't say if it's all your money, some of your money, whatever it is, that amount, 25%, you buy the VIXM with that 25% for that strategy. Balanced right now is in gold, 25% in gold. Defensive is in cash, and the vol trend is in one broken wing butterfly on the UVXY. So 4 positions, 25% each one of them. Not options. Don't think there are records on your website, but just for security, not options. Since February 2022, have most VTS trades ended up being losing trades? Since February 2022, so vol trend's doing well. Our UVXY broken wing butterflies doing well. Defensive is doing fine since that date, but January was not fun. But once we got the signal to go either utilities or cash, good. That's good. Balanced strategy was doing actually really well, all things considered. I mean, it's not doing well, but very, very good, relatively speaking, up until about a week ago. And then, of course, the market crashed, and a couple of those days we were in it, so we had the drawdown. And then strategic is maybe not the worst. I don't know. But no, we've had a few things that, relatively speaking, are working, and we've had some things that are, definitely not working. But the reason I don't, well, there's many reasons I don't put all the daily emails up on the website. One of them is just brevity. I just don't have the time to do that. But also, I don't like when people get hyper-focused on the day-to-day, so to speak. Losing trades and drawdowns, it is part of the process. And if I'm always out there every single day focusing on every single trade and, this one won and this one lost and our win ratios, this and that, it actually it's detrimental to investors. It gets them short-term thinking. And if you want to be successful, not that you shouldn't care about short-term losses. You absolutely should. I do, and I manage it as best I possibly can. But you really do want to take a long-term focus. So I don't like to just flash good and bad. I mean, when we're doing really, really well, I'm not out there saying, oh, we're just crushing it week after week. Look at how great I am. I never do that. I never brag during good periods, and I never make excuses during bad periods. Focus on the long term. And so I don't actually like to put the trade record of all the daily emails up on the website because that's short-term thinking. We're in a drawdown, and it's an uncomfortably bad one. So relatively speaking to the market, it's much better, but it's still unacceptable for me and my standards. So hopefully we'll get out of it. Option trading is a good start to get out of it. Hence why I'm sitting here in this country all by myself with nothing to do but work. I would kind of present my live portfolio of trading activity. Is this a good idea if I have a disclaimer about it being for education purposes? Yeah, I would say that as long as you're an honest person and you're genuinely trying to help people and you're not doing this for short-term benefit like making a bunch of money, I would say that that's what you should be doing. If you feel the need to, if you feel like you're good at this, you're good at investing and you have something to share it. Absolutely, share it. That's how I started. I launched my first website in 2008 or 9, around, I can't remember exactly when, but sort of financial crisis-ish. And I never had any intention of doing this as a business. This was never my intention, like, oh, I'm going to do a subscription service. I was trading my money by myself, full-time job, no intention of ever doing this. And then I started sharing my work with people. You know, a year goes by, I get a couple of people following. Another year goes by, I get people emailing me, hey, you know, I like what you're doing. And 3 years later, I had so much demand from people saying, hey, can I send you some money and you can send me the trade signals? And I thought, yeah, I can do that. Sure, I can, you know, send you an email 5 minutes before or whatever. And so I started doing that, and it builds slowly. And then I went back into my cave back in 2012, and I launched it for real, did a website, wrote a bunch of articles, and I really focused it all. But what you're saying here is what I did. So yeah, I would always encourage you. Like I said, there's a million people out there launching subscriptions and this strategy and that. 99% garbage. You have to know that it's not broad net worth. It's tiny portions of capital taking on excessive risk, and they're promoting their winners and ignoring their losers. But if you are a person who is genuinely trying to help people and you legitimately are good at what you do, then not only would I say you should do that, but you owe it to yourself to do that. Like, get it out there because people need help. This investing is really, really hard. The vast majority of people are making no money, despite what all those people on Twitter will be telling you about how apparently everybody's a millionaire trader. But in reality, very few people are. And so, yeah, if you're good at this, go for it. Second question, could I get in trouble for bad trades, people losing money? That depends on how ethical you are with it. You know, the way that I do it, all VTS is me trading my own capital in my own account, and I'm sharing the trades with the public. I don't tell anybody what to do with their money. I'm not out there soliciting clients. I'm not bragging on Twitter. Go follow me on Twitter. I've never blocked anybody in my life. I don't have any beef with anybody. I don't get in back and forth arguments. I don't have other subscription services, you know, insulting me. I don't have any asset managers out there looking down on me like, oh, this subscription guy. I do it all ethically and above board, and people know that I'm being genuine when I say, and I have bad periods too, so I don't hide those. It's actually a feature. When you tell people that I'm human and I have good periods and bad periods, it's actually a feature. Being honest and actually trying to help people is surprisingly the best way to succeed. A lot of people they avoid that at all costs. They avoid saying anything negative. They avoid taking any responsibility. They hide everything they did wrong. They focus on everything they did even marginally right. They exaggerate it to death. It's actually not a way to succeed. The best way to succeed is to take a 5-year long-term process-oriented approach to it and actually help people, right? That's what an entrepreneur is. Just identify a pain point for people and fix it for them. One of the pain points that is one of the most important things in the world, like I've said before, I'm not curing cancer here, but helping people with their investments is an extremely important job. So the pain point is nearly everybody out there is underperforming. Fix it for them. If you're the guy that knows how to do that, then you owe it to yourself to do it, and you owe it to other people to help them, because investing is extremely hard and very few people actually are good at it. A lot of people tell you they're good at it. Millions of people will tell you they're good at it, but very few people actually are. So I hope you're one of them. I recognize the name. You've been following for a while. So yeah, email me. I'll always help you out. All right, we're getting to the end here. It was at 10:20 at night in Dubai here. Have a subscription issue I sent to the, yep, that's the right place. I'll check it out later. What were some of the influences on you that led to the models you build, people you look up to? I hate when people ask this question because I always feel like I'm punting on the question. But again, I tend to be an outlier. I know when you ask people this question, they'll give you a list of books that inspired them, and these people are my mentors and all that stuff. I'm not belittling other people. I'm sure they're fantastic at what they do, but I always forge my own path. I didn't follow anybody. I didn't get influence from anybody. I don't look at anybody. I don't follow anybody. Oftentimes I get people ask me, hey, what do you think of this guy? And I'm like, I don't know. I've seen a tweet or two. That's about it. I just do my own thing. Because really, at the end of the day, when you look at the number of people who actually perform well with their investments, it's a surprisingly low number. So why would I want to get influence from somebody who's very likely not good at their job, right? You talk about the giants in the industry, the names that I would throw out that everybody knows those names. Well, those names are not performing well. Those names might manage a lot of capital, but that doesn't mean that they're actually good at investing. In fact, what we know is probably 80 to 90% of them can't even beat the S&P 500. So do I want to listen and gain influence from people who demonstrably can't outperform the index? Probably not. So I just entirely do my own thing. I don't care if people think it's right or wrong. It's just what I do. So I'm not punting on this question. I just have no mentors. I didn't read any books. I don't have any influence from other people. What I do is mine. It's probably why it looks so, some might say odd, some might say unique, but there's nobody else. I've had some copycat services. People pay me for the subscription and they literally copy and paste my signals and give to somebody else. I've had a lot of that. But I've never seen somebody sort of organically create something that looks like my portfolio. So that's probably why. I've never even looked at anybody else's work. I have no idea what they're doing. I track performance very well, and I know the performance is horrendous in the financial industry. So sorry, can't help you out with that one. Same question. Can't help you out. I'm a self-taught person. If you saw my golf swing, you'd think the same thing, right? I was a pro golfer, but if you saw my swing, it doesn't look like Rory McIlroy. It's self-taught. Basically, my dad and I, hey, give this a try. See what that works. Go out on the golf course, hit a bunch of shots, play a few rounds, see if it works. If not, fix it. Entirely self-made. Okay. That's it. We're at the very end. So that wasn't so bad. Hour 23, that's too long. I should have cut it at an hour, but thank you very much. On your way out the door, if you wouldn't mind, give it a like anyway. I know you've watched the entire thing, but give it a like anyway. It really does help me out. And like I said, I will really try to commit to a weekly live stream. So hopefully everybody enjoyed it.